Tim Hopper, you're based in Houston, so tell me, are people feeling much better now that oil's at 60 as opposed to 40?
At TIAA-CREF, we think that the oil prices are basically bouncing along the bottom. So we've seen 40, they've come up back to 60, and it looks now like net we're going to see higher prices in the second half of the year relative to what we've seen so far. And in Houston, of course, they like this because prices at 110 are great for companies in Houston, but they can operate quite successfully in a range of 60 to 80. And so kind of where we are now, as long as this is at the bottom, that's going to be pretty good for Houston.
Well, Greenlight Capital's David Einhorn gave a presentation recently saying that a lot of the frackers are in big trouble. He was talking specifically about Pioneer. But what's your view about the fracking industry right now? Are they in trouble?
So the service sector, of course, has come under pressure since oil prices have come down. But we're basically at the bottom. We've seen a rig count that's essentially cut in half. And where we are now is at the point where production is being cut. Oil is now net going to be coming out of storage. And so what we should see going forward is actually a stabilization in the service sector. So the fracking industry has probably seen the worst of what they're going to see.
And higher oil means more inflation, which I'm sure the Fed likes because they're trying to engineer that. So what's your view of inflation going forward? Because we haven't seen the wage gains, at least according to the April jobs number, but oil's moving up.
That's right. And so while inflation has come down over the past year, it's now stabilized and it should start going up. And so the oil trade is good for inflation. It's stabilizing and will move up. And then on the wage front, we have not seen much wage movement yet, but the signs are really there that we will. And so we think at TIAA-CREF that by the second half of this year, especially later part of this year in the fourth quarter, we should see a measurable uptick in inflation, or at least the trend should change. And that really sets us up for better inflation and of course, a happier Fed in 2016.
All right, well, the Fed will be happy if we get economic growth, and it was flat in the first quarter. Tell me how the rest of this year is going to play out with regard to growth.
So we had a very disappointing first quarter. However, if the short answer really is that the recovery is on track. So we thought at the end of last year that the recovery was picking up. That was moving from about 2.5% to 3%. This year, it's really looking like we're going to stay in that 2.5% track. So the recovery is on track, but it's not really accelerating, and that's probably good for markets in the sense that the Fed is going to raise, but maybe not as soon and is not by as much.
And then finally, putting all this together, where should people put their money? Because we're hearing that over in Europe and Japan, they're moving much faster than us.
Yeah, so on a relative basis, while the U.S. is still doing relatively well, Europe and Japan, they've really entered a QE phase, which is more akin to what we were in 2011, at the beginning of a very long QE cycle. And in Europe, for instance, that means that we should see more stimulus for an extended period of time, and that should actually help. So where you have earnings that are peaking or at least moving sideways here in the United States, in Europe, there's a lot of potential for earnings to actually accelerate, and that should actually boost returns in financial markets.
All right, thanks a lot, Tim.
Thank you.
Thank you for watching The Street.